Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Robb, how was your travel last week?
Travel was good. Yeah, travel was great. Had a great trip. Was in Delaware, New Jersey, New York. Apologize if I sound a little nasally. I think I picked something up on the New York subways. You know how those can be. But yeah, it was a great trip. Met a lot of cool people. Saw a lot of different cool projects that people are working on. So it was an investors summit in the automotive and mobility space. So yeah, I had a great time out there.
That's fantastic. Although it does sound like that soft California living is not doing you well. 10 minutes in New York and you've already come down with an illness.
The amount of travel and then dealing with whatever it is you guys call freeways or on ramps
That's
and
not good. Yeah.
curves and bends. I thought California traffic was bad, but that was absolutely nothing. Wilmington, Delaware to where were White Plains, 4.5 hours and 45-minute drive. Yeah.
But how
Where I
many?
think it
But
was.
very few miles.
Yeah.
It's not far, but it's long.
It was. So, but yeah, great trip. So apologize again for all of our viewers if I'm a little nasally. But we've got another great show for everybody today. We're calling it the Let's Look at the Data issue. We're circling back to new portfolio pick for DKI, AuthID. We're talking Lyn Alden makes an appearance here on this show. Not in person, hopefully maybe one day, but at least we'll be talking about her a little bit. PPI, CPI, and we're talking the dollar again. Gary, you ready to jump right into it?
Let's go.
All righty. Thing number one for this week's version of the five things, the let's look at the data issue. AuthID, ticker AUID, reports first quarter.
All right. So, we've been talking a lot about the importance of biometric authentication, that my Twitter or now X account was hacked. And, that there were people who said, hey, why is that a big deal? It's social media. Who cares? But, imagine it had been your bank account or your brokerage account or, your identity. These things do matter. AuthID has the best in class, fastest response. They can authenticate somebody using a passive selfie. That just means a one-time selfie in 7/10 of a second. The company announced their first quarter, their first quarter last week, and first quarter revenue was almost as high as the revenue from all of 2023. And the company gave guidance for the first time. And that guidance, if you just take a revenue run rate, indicates they think their quarterly revenue is going to double later this year. So first quarter revenue, almost the same as 2023 full year. Revenue in the second, third, fourth quarter, we're looking for something in the neighborhood of double what first quarter revenue was. And one thing that we were really excited about is, there have been people complaining about the company's BAR metric. It stands for booked annual recurring revenue. I was among them. I thought it was a bad metric to be using. I thought the CFO, Ed Solito, did a fantastic job clarifying this previously confusing metric. Star intern Andrew Brown is going to put up a slide showing you from the company's presentation where they broke everything out from their contractual commitments from their customers and then their usage above commitment. And so that if you add them together, you end up with BAR. But the company is going to have better, more clear, discrete reporting going forward. And I thought that was a huge plus. I thought Ed did a really nice job breaking that out.
Sounds like a lot of good positive stuff coming from the reporting, Gary, playing devil's advocate. Anything worrisome? Any hurdles that you see in front of the company? And then what are some of these catalysts that might be on the horizon?
So I don't know. Yeah, there are some hurdles. The first one is the company is onboarding 6 new customers this quarter. And, we've described them before as a public venture capital company. So, they do need to have to onboard these customers successfully, to be able to scale that business, to be able to start to authenticate more people each quarter and each month. I think they're equipped to do it, but we're going to find out this quarter. But basically, DKI has listed 3 near-term catalysts for the stock. One is better financial reporting and clarification of financial metrics. They've done that. And then there are 2 more things they really need to do this year. One is the reason new CEO Ron DeGuro was brought in last year is because he's a sales expert. He's fantastic at putting together sales teams that are systematic. And the company needs to sign some new customers in the second half this year. It's not going to happen in the next month or two, but in the second half, they're going to have to sign some new customers and show that they can grow the business. One of the reasons we're invested is I have confidence that Ron and his sales team there will be able to do it, but they need to execute. And then the third thing, the third catalyst that we need to see this year is the company's going to need about $8 to $10 million of financing sometime around October or November. They've been open about it. I have a model on the company. I agree with the company. That is what they're going to need later this year. I have a high degree of confidence that the existing shareholders will step up and will be able to fund the company into next year, at which point I think by the end of next year, AuthID should be self-financing. So those are basically, we said there are three catalysts. One is down and they're going to need to do these other two things in the second half. To me, it looks good, but we'll see what happens over the next couple of quarters. We'll be watching closely and be communicating with the company and, looking to see that they follow through on everything they say they're going to do.
Definitely. And we'll be sure to keep everyone here in tune as well, both on the five things as well as in written reporting when necessary and available. Thing number two, we're moving to Lyn Alden. Lyn Alden summarizes an entire ebook in one post. Is she going to put you out of business, Gary?
I wouldn't put it past her. She's fantastic. Lyn is a super smart person. She's also a really good writer and communicator. Last year in the fourth quarter, DKI wrote an ebook called Counterintuitive Inflation. And in that ebook, we explained how Federal Reserve rate hikes can lead to more inflation. And basically, the short version of that is, the US is borrowing right now about $35 trillion. So if you increase the interest rate, if the Fed hikes to try to control inflation, what that's going to do is it's going to increase the interest expense that our government's going to have to pay. And because we're way, way, way over budget, what will have to happen is we're going to have to print more dollars to pay for it. Well, guess what you get with more dollar printing? You end up with more inflation. And so, we put out this 20-page ebook, Counterintuitive Inflation, with 17 charts and graphs in it to explain all of that. We've also written extensively on the quiet war between the Fed on one hand, who's raising rates to try to control inflation, and Congress and Treasury on the other hand, who's been overspending and monetizing that overspending at a level that's creating more inflation. So these two parts of the government, and yeah, technically the Fed isn't part of the government, but it really is. They're at odds with each other. And so, Lyn summarized it all. I'm going to read her tweet or post on X. Some analysts say that monetary policy is not tight enough to curtail inflation. The real issue is that fiscal policy is too loose to curtail inflation. And at 120% public debt to GDP ratio with ballooning interest expense, tighter monetary policy loosens fiscal policy further. So there it is. She basically summed up a 20-page ebook in, one tweet. So her work is phenomenal.
Gary, we know we've talked about government reducing spending and the likelihood of that happening essentially being close to or if not near zero. What does the world look like for the average American if rate hikes like what we had in the 70s don't work? And in fact, we think that they probably will not work the way they should to curtail inflation.
Yeah, that's a great question, Rob. So, back in the 1970s, when the US had this huge bout of inflation, debt to GDP was around 30%. And what that meant was that Paul Volcker, who was the chairman of the Federal Reserve at the time, raised interest rates to right around 20%. Okay, so for people who, you don't like your mortgage payments now, or, you don't like your credit card bills now, try to imagine what it would look like with interest rates at around 4 times the current level. And the issue is we can't do that now. Powell can't raise rates that way because he'll just end up creating more of the same problem. And that's Lyn's point. And the term she's used to describe it is fiscal dominance, which simply means that we owe so much money and we've spent so much money that what the Fed does with monetary policy is just it's not that effective. And, realize it was just 2.5 years ago that Jerome Powell, the chairman of the Federal Reserve, Janet Yellen, secretary of the Treasury, were saying inflation's transitory. They thought they'd have this knocked out in about 12 months. And 2.5 years later, they're realizing that they may not be able to lower rates at all this year. So this is turned into a multi-year non-transitory problem. Um, your question is, what does this mean for people? And the answer is inflation works for wealthy people who can use debt to buy hard assets. It's great for property owners. It blows up bubbles, so you end up with higher stock market prices. And that's great for wealthy people who own a lot of stocks and who own property and have access to debt that will be devalued over time. It's horrible for most of the country because if you're spending the vast majority of your paycheck to ensure that you have health insurance and your rent or your mortgage, maybe childcare, car payments, food, putting gas in the car. I mean, I've just in a few words there summarized most families' expenses.
Mhm.
Those things are all going to be much more expensive. Um, the best way to protect yourself if you're an investor is to look at dollar alternatives, things like gold, Bitcoin. Silver it just crossed 30 for the first time in years. We had Ryan Sullivan on last week talking about agricultural prices. Basically, commodities are hard assets, and these are things that are easy to buy using ETFs if you're not in a position to hold the physical, and most people are not, right? Most people are not in a position to hold a lot of physical commodities, certainly not oil or uranium. Um, but those are the best ways to deal with it for the part of the country that's living paycheck to paycheck. It's going to be very, very rough. I wish I had better advice, but the only thing you can do in that situation is, do your best to cut expenses, to save, to buy things like, large stocks of food when they go on sale. And I realize for a lot of people, if you're living paycheck to paycheck, a lot of what I'm saying is not going to be possible. I wish there were more I could do about it. I'd love to tell you, just vote for more fiscal sanity. But, we had that great point from Mike Shedlock, Mish, who's on the DKI board of advisors from, I think it was 2, 3 weeks ago, when Mish was saying, hey, you can't vote your way out of this. Neither party is going to cut spending. Unfortunately, I agree with him. So I think, the policies that Congress is enacting in the name of trying to help people are going to make life very hard for a lot of people. I have sympathy for it. I don't have the power to stop it. And, I'd also point out that, when Lyn is talking about fiscal dominance and the problems with that, that doesn't mean she is rooting for a particular policy. It doesn't mean she wants that to happen. She's saying this is the result of what is happening.
Moving on to thing number 3, Gary, and we'll get into a couple of reporting metrics here for thing 3 and 4. First one being the PPI, Producer Price Index, comes in hot.
Yeah. So the producer price index, the PPI, it's a measure of wholesale prices. And the reason that matters is those prices that manufacturers have for the things that they put into the things that they make for the rest of us, they make their way into retail prices. Think about it like a leading indicator, right? So if you're making televisions and the cost of the screen goes up or the cost of the stand goes up or the speakers goes up, then you would expect that in the next 3 months, 6 months, year, you're going to have to raise the price of those televisions to people. And so the PPI is kind of an early look at inflation a couple of quarters down the road. So the April PPI was up 0.5% from last month, which was a lot higher than the 0.3% expected. Now I realize it doesn't sound like a lot, but when you start to annualize that, you're right around 6%, and that is not the 2% the Fed is aiming for. The yearly PPI was up 2.2%. That's also an increase from recent levels. And the core PPI, which excludes food and energy, a lot of people like to look at it because it's less volatile. That was also up 0.5% from last month. So basically, the core and the regular PPI are both ticking up. When Andrew puts up the chart, you'll see at the end of the chart, both the blue line and the red line start to tilt up. And that's because we're getting more inflation, not less.
With that being said, Gary, do you think there is a situation with inflation rising that the Fed actually raises rates again this year?
So what's really interesting is it's actually become part of the conversation. And we've talked about this before. We came into 2024 with people expecting 6 rate cuts. So that's a total of 1.5%. And they thought the first rate cut would come in either January or March. And then, a couple months ago, people came around and deep knowledge investing, we were out telling people, no way, not going to happen. Take the under on that. Expect higher for longer. And, we've been right, and the world has been coming around to our point of view. And, recently the conversation has been somewhere between 0 and 2 rate hikes. So between 0 and 0.5%, maybe starting in November. And that seemed to make sense. But now there have been a couple of Fed governors who've come out and actually started to talk about the possibility of having to raise rates later this year. Now, do I think it's going to happen? No, I don't. I think the Fed is most likely to hold rates stable into the June meeting. And then, once we get to like the September and November meetings, we're right around the election. And it's important for the Fed to try to appear like they're not politically motivated. You change rates up or down just before the election, and there will be allegations that, they're trying to help one party or hurt the other party, depending on what they do. I think the Fed is most likely to stay put right now. The conclusion on all this is higher for longer, still with no near-term rate changes. Now, new data, we could change our mind on that, but that's my call on this for right now.
Sounds good. And just to note for Gary, it's May 20th, 2024 for anybody that may be pulling this up from in a future date. Thing
There
number
we go.
4, as we mentioned, talking about indexes, once again, the CPI, Consumer Price Index, comes in light.
Yeah, so this was the opposite of the PPI. The PPI came in above expectations. The CPI, which stands for Consumer Price Index, came in a little bit lower than expected. Now, for people who are, not sure which ones, which metrics we're looking at, when people talk about inflation and they say inflation was up 3% or 2% or 5%, they're typically talking about the CPI. Now, over the last few years, Deep Knowledge Investing has taken the CPI apart and explained why it's inaccurate in a lot of ways, how it's manipulated. I don't think it's really a good measure of inflation, but when people talk about inflation, this is the metric they're talking about. So the April CPI, Consumer Price Index, came in at 3.4%. That was in line with expectations and below last month's 3.5%. The core number, which again excludes food and energy, was 3.6%. That's a little bit below last month and also consistent with expectations. The issue with this stuff is 3.5%. The monthly change was 0.3%. That annualizes to 3.7%. Again, the Fed's aiming for 2%. They're not getting there. There were also other issues with the report. Food at home was up 1.1%. I continue to insist that anybody who thinks food inflation is only 1% hasn't been in a supermarket. If you're listening to this, put it in the comments. How much do you think your grocery bill is up in the last year? If your grocery bill is only up 1% or less, I definitely want to hear from you. You would be the first person to tell me that. Car prices have continued to decline from the insane COVID levels. Energy prices have started to tick up a little bit from last year's reduction. But the big thing that's hard for the Fed is we've got sticky services prices, and that's a huge problem. That's up 5.3%. A lot of that is wages. And so, people are going to their employer saying, hey, wait a minute, my expenses are up, my rent is up, my food is up more than 1%. My car payments are up. You got to pay me more. And it's costing more to keep employees. And I understand, why people want raises. They're not unreasonable, but the issue is we've got a wage price spiral right now where people are understandably and reasonably insisting on higher wages. But then the issue is we end up with services prices up 5%, 5.5%, and that makes it hard to get inflation down.
So I'm going to go the opposite direction now with this question, Gary. Is there a chance that Powell follows Burns in the 70s and then he actually reduces rates too early before inflation cools, or do you see that happening on his watch?
I think I think they're looking at it. Powell and the rest of the Fed, they have talked openly about wanting to cut rates later this year. He's been careful. He said, we'll be data driven. He hasn't made any promises. Um, but I do think that that Powell is somebody who is very aware of history and very aware of how he'll be thought of by future historians. I really think he does not want to go down as the second coming of Arthur Burns. I think he's really worried about letting up on the Fed funds rate too early. And in doing so, if there's another round of inflation, and I think there will be, if that happens, he's going to be looking horrible. He will he will have made the same mistake that has been made before in his lifetime. And there's a special place in financial hell for people who make the same errors that have been made before. He knows better. So I think they're looking at it, but I don't think that he's going to do it. And then I come back to the point that we made before, which is, take a look at what's going on. Bitcoin hit 70,000 today. Gold has hit all-time highs. It's closing in on 2,500 right now. Silver back above 30 for the first time in years. Higher overall commodity prices, higher agricultural prices. All of this is telling me that the entire world is expecting more inflation. That's my view. If you have an alternate opinion, again, put it in the comments. If you think this huge increase in commodity prices is something else, I'd love to hear it. But my view is Powell's looking at this and he has to know that they do not have inflation under control yet. He'll talk, but I don't think they're going to lower rates anytime soon.
Thing number 5 to wrap up this week's edition of the 5 Things, Gary. Talking dollar now. Is the dollar both losing and gaining share?
Sort of. Yes. No. Are we good? Can we go?
Yeah, right. I had the same question to you prior.
Yeah. Here's what's happened. Over the last couple of years, I've written a lot about how the dollar is losing share as the world's reserve currency, and that is factually true. And reserve means foreign governments holding the dollar as a store of value, as a way to engage in international trade. A lot of international trade is settled in dollars. If you want to buy oil from Saudi Arabia, with very few exceptions, you have to pay in dollars. So other countries hold dollars. And the holdings of foreign governments of the dollar have been falling for years. China has been responding to a deteriorating relationship with the West by holding fewer dollars. They've been selling treasuries. Japan's been selling treasuries to defend the yen. That hasn't worked. And the other thing is the US has been debasing the dollar with excessive debt. And the government has stolen the dollar reserves of countries engaging in behavior that Washington, D.C. dislikes. And, you could say, hey, we know you're talking about Putin and Russia and they deserve it. Okay, fair enough. That is a totally valid point of view to say the US is doing the right and moral thing, except the problem is it's going to harm Americans. When you use the dollar as a weapon, people view it as an enemy currency. And all of that activity, again, I'm not commenting on the morality of all of this. I'm not supporting Russia in any way. But Washington has been using the dollar as a hammer against other countries, and that makes other countries fearful of holding dollars. And so what's happened is other countries have been reducing their government holdings of dollars, and yet foreign holdings of US debt have not decreased.
And Gary, previously you said that the dollar is losing share as the world's reserve currency. Is that still your opinion? Are you sure about that? How can you be sure about that in terms of where the dollar currently stands?
Well, so there has to be something making up the difference. Basically, the dollar has been losing share as the world's reserve currency. Foreign government holdings of dollars are decreasing. So, but for federal debt held by foreign and international investors has gone up. So how does that make sense? The only way it makes sense is there are treasury securities held by private foreign investors that have gone through the roof. And that's what's happening. So while the Chinese government and the Japanese government may be selling US treasuries and other governments are selling US treasuries, the citizens of countries all over the world have been buying US treasuries because they'd rather hold the dollar than their own currencies. That's part of it. The other thing that's happened is Powell and the Fed have been more hawkish. That means favoring higher rates than other central banks. And so the rate on US treasuries, the interest rate on the US 10-year bond is above what it is in the UK, in the EU. It's far above what you get in Japan. The US 10-year has been around 4.5% or so, a little higher, a little lower at times. In Japan, it's less than 1%. And so, because the Federal Reserve has been more aggressive in raising rates than other central banks, the citizens of those other countries have said, wait a minute, if I hold dollars, I can get a higher interest rate. And so, the conclusion here is that the US can create demand for Treasury securities as long as we're willing to pay for that demand. And so, this activity is keeping our government solvent. But, as Lyn Alden noted in her post on fiscal dominance, it's also going to create more inflation.
That's a wrap, everyone, for this week's 5 things. Gary, anything else to add on any of the points that we may have covered over the course of the show?
No, I think we're good on this. For everyone watching, thanks so much. We appreciate your time. The channel's grown a bit. Thanks and welcome to the new subscribers. We really appreciate you clicking that subscribe button. And it's nice that you guys wanted to spend this time with us. We know your time is valuable, and we appreciate you watching. Thanks a lot.
Thanks, everyone.